So here's where I want to pick up where we left off. Okay. So we spent Tuesday of last week talking about one way of looking at costs, which is thinking about them in terms of direct versus indirect. Okay. And then we spent Thursday, we switched tracks and moved to a different way of thinking about costs, which is fixed and variable. Right? So if you could please summarize to me in your own words, that's what I'm interested in, the distinction between fixed costs and variable costs. In your own words. Okay? Okay. Good example. Then so fixed cost is something, so I'm just going to repeat what you said. He said something that you pay regardless of whether you use that resource or not. So what I heard you say? So a fixed cost is something that you commit to incurring upfront. You're committed to incurring that cost at a certain amount. That cost stays the same regardless of what your underlying activity or your underlying usage of that resource is. Okay, so a classic example of something that works like a fixed cost is a cell phone contract. You pay $40 a month for usage between 0 and 1,000 minutes. That's a classic example of a fixed cost, because regardless of what your actual usage is, between 0 and 1,000, your total cost stays fixed. You incur that cost as a lump sum, okay, regardless of your actual usage or your actual activity or your actual production. Most of the time, the activity that we're thinking of is production, how much you produce, right? So that's a fixed cost. A variable cost, on the other hand, is something where your total cost varies proportionately to your activity level. The more of an activity you do, the greater that cost becomes in total. The less of an activity you do, the smaller that cost is in total. Sometimes if you don't do that activity at all, or you don't use up that resource at all, you incur no cost. Okay? So we're very familiar with costs that function in both of these ways, just from daily life. Okay? And so we just carry that intuition over into a corporate setting and you have your distinction. Now there's one issue that I talked about, we talked about for about 15 minutes last week, and which I want you all to keep in mind, which is how variable and fixed costs function on a total basis as opposed to on a per unit or an average basis. Okay? And we made a very important distinction here. Remember, the terminology variable and fixed refers to how those costs behave in total dollars or in per unit dollars. When you talk about costs being variable or costs being fixed, are you referring to their behavior on a total dollar basis, or are you referring to their behavior on an average per unit basis? On a total dollar basis, right? So fixed costs in total remain constant. Variable costs in total fluctuate. When you look at them, on the other hand, on a per unit or on an average basis, the behavior reverses. It flips. It's the other way around. Variable costs fluctuate in total, but on a per unit basis or on an average basis, they normally stay the same. Those costs are usually incurred in that manner. They're incurred as a certain number of dollars per unit of activity or per unit of that resource. $5 per gallon, or $5 per mile, $2 per minute. Okay, so the more minutes you use, the more gallons you use, the more miles you drive, the larger that cost is in total. Fixed costs, on the other hand, are the exact opposite. On a total basis, they stay fixed, but on an average or a per unit basis, they vary depending on how much your activity is. Okay, so the simplest example, the easiest way to visualize this is to think of your classic fixed cost, which is rent. Okay, the cost that you pay for space. Imagine you rented out a space that can make up to 50,000 cars and you're paying $1 million in rent. Okay, now if you make 100,000 cars within that space, your average cost per car is $10. Right? If you make 200,000 cars within that space, your average cost per car is now $1 million divided by 200,000, which is $5. If you make 500,000 cars in that space, your average cost per car is now $1 million divided by 500,000, which is $2 per car. So fixed costs on a per unit basis always vary. And how do they vary with your activity level? Do they vary proportionately to activity, or do they vary inversely proportional to activity? Inversely proportional to activity, because the more activity you do, the lower your average fixed cost becomes. Okay, and this illustrates an important concept in micro, which is economies of scale. The fact that as you produce more, as you scale up, that's a term that economists like to use, your average cost of producing becomes smaller. And economies of scale relies on the fact that you have some fixed costs in your cost structure. If all your costs are variable, you're not going to get that many economies of scale. Okay? So now that I hope we've reminded ourselves of fixed and variable costs, here's what I want to do. I want to spend 5 minutes. You remember these two examples, the NUMI example and the consumer focus example. We used these examples when we were classifying costs into direct and indirect. Now we're going to go back to the same example. We're going to classify the same costs into fixed or variable. Okay? The same exercise, different requirement. So this is the NUMI plant. Remember, it's a car manufacturing plant. They make two types of cars, Corollas and Geo Prisms. This time, we want to classify each cost as variable or fixed with respect to how the total costs change as the total number of cars of each type assembled changes. So here what you need to ask yourself is, if I make more cars, is my total expense for that item going to go up, or is it going to stay constant, stay fixed? Okay? So let's quickly run through those examples. The cost of tires, clearly variable. The salary of the public relations manager. The annual awards dinner for the Corolla supply. Anyone thinks it might be variable? So is this item, is it a single cost item, or is it something that's composed of other cost items inside it? There's other cost items inside it, right? An annual awards dinner can be composed of so many different parts. There's a cost for renting out a banquet hall, and there's a cost for catering the food, there's a cost for flying in all the participants, buying them prizes, paying for their expenses, and you can imagine that some of those costs might be more or less fixed, like the space might be more or less fixed, whereas other costs, like the number of people that are receiving prizes, might vary as a function of how many cars you sell that year, right? So some portion of this is likely to be fixed and the other portion is likely to be variable. The salary of the engineer who monitors design changes on the Geo Prism. It's fixed unless you know anything else about it. You can assume that salary is always a fixed payment. Salary, in fact, refers to a fixed payment, okay? Freight costs of Corolla engines shipped from Toyota. How do you pay for transportation? Usually by volume, by cubic feet, or by area, by square feet. So the more you assemble, the larger your cost is. It might not be linearly increasing with the number of cars that you assemble, but it's definitely going to change. The electricity cost for the NUMI plant. Variable. The more cars you assemble, the longer you run your machines for. The longer you run your machines for, the larger your electricity bill is going to be, okay? So you can do the rest of the examples and stuff. Let's move on to the second setting, which is consumer focus. Maybe somewhat fixed. There's some portions of it will be fixed and some portions will be variable. We'll talk about it. There's a word for that. It's called a mixed cost, or just a semi-fixed, semi-variable cost. Okay. But it's deceptive because that item is not a single cost item on its own. It's a combination of many other items, so it doesn't really have a name. Okay. So remember the consumer focus example in setting? This is a company that did market research. Remember? That organized focus groups that met, and there was a marketing expert that offered new products to the focus group and then collected their feedback. And then this feedback would be given back to the companies that are manufacturing those products, who are in turn the clients of consumer focus. Okay? So that's the setting. Now, what the requirement is, think about whether the cost is fixed or variable with respect to how total costs change as the number of focus groups conducted changes. So what you want to ask yourself now is, the more focus groups I do, is this cost going to increase or is it going to stay constant? Okay? Payment to individuals in each group to provide comments on new products. So So remember what the terms were. There was 8 people in each group, and each person got $50. So it's $400 per group. So if you do 10 groups, what's your total payment? 4,000. You do 20 groups. So what is it? Fixed or variable? Fixed or variable? Remember, the term variable applies to how the cost behaves in total or per unit. Is it fixed or variable? Variable, because the cost is incurred per group at $400. So the more groups you do, the larger your total cost is. If you do 10 groups, your cost for participants is 4,000. If you do 20 groups, your cost is 8,000, and so on. It's a classic variable cost. Okay? It is fixed per group. Yes, it's 400 per group. But remember, variable costs are fixed per unit and vary in total. Okay? So don't let that throw you off. The annual subscription of Consumer Focus to Consumer Reports magazine. Fixed or variable? One subscription, you pay for it at some $100 a year. Regardless of how many focus groups you do, it's going to remain $100 a year. So it's a classic fixed cost. Okay, phone calls made by Consumer Focus staff to confirm that individuals will attend a session. Fixed or variable? So the more groups you do, the more participants you have, and the more phone calls you have to make, right? So it's a classic variable cost. Okay. I'll read this item out and I'll remind you what it is. The retainer paid to the focus group leader to conduct 20 sessions per year. So you remember there was a marketing specialist who was leading each group, right? And the marketing specialist was being paid through a combination of two components. He was paid a fixed retainer, which is a fixed salary, let's say $40,000 a year, and then she was paid a commission of some $2,000 per session that she did. So now the question is the retainer, the $40,000 a year that she's getting paid. Is that fixed or variable? Clearly fixed. Also, another clue that should help you think about that is the way in which the cost is expressed. Okay, this cost is expressed as a certain amount of dollars over a period of time. So it's a classic indication that it is a fixed cost. And the meals are variable, the lease payment is fixed. You can work through the rest on your own. Okay? But I hope this gives you a flavor of how to think about fixed and variable. Always ask yourselves first, what is the measure of activity? What's the underlying measure of activity? So in the NUME example, you were told the measure of activity is the number of cars assembled. Okay? So once you know that, you ask yourselves, the more cars I assemble, is my total cost going to go up or not? Okay? The second, the consumer focus example, the measure of activity was the number of focus groups conducted. So you ask yourself, if I conduct more focus groups, is the total cost going to increase? That is the question you should ask yourself and try to answer every time. Okay, if you put it into that framework and think about it that way, it's very hard to get confused. And you may even want to do some examples for yourself on paper. Ask yourself, if I do 10 focus groups, what's the total cost going to be? If I do 25 focus groups, what's the cost going to be? And take 3 or 4 examples of different activity levels and write out for yourself what the cost is. If you find it increasing, it's clearly variable. If you find that it doesn't change, then it's fixed. Okay? That's the way to go about convincing yourself that the cost is fixed or variable. Take 3 or 4 examples of different activity levels and calculate for yourself what the total cost is going to be. Okay? Any questions? Okay, so just like we did for direct and indirect, I want to point out a few facts about the fixed and variable classification. Okay? We don't need this, so a few facts, many of which you guys have realized already, some of you have raised in questions, but it's just worth going through all of them. So, over a period of time, when you look at many examples, you start forming these impressions in your mind that certain cost items tend to generally be variable and other cost items tend to generally be fixed, right? So if I tell you, let's say, raw materials, what are you thinking? Are you thinking fixed or variable? Variable, right? The more cars you make or whatever it is, the more material you have to use. Or your hourly wage laborer. Variable, that's what you're thinking. Now what if I tell you rent? You're thinking fixed. So you tend to make these associations, right? And the associations are not incorrect. They're generally what we develop through looking at many examples over a period of time. But here's the thing to be careful about. Do not assume that certain cost items are inherently always variable. and that other cost items are inherently always fixed. Okay? Because you can always think of situations where the examples that you gave me for variable, where materials and labor are fixed costs, where rent is a variable cost. Let me give you an example. So you think about your classic manufacturing situation. You have workers on the assembly line who are being paid, let's say, $10 an hour to assemble your cars. Okay? So if you assemble 1,000 cars as opposed to 2,000 cars, clearly in the second situation, your workers have put in double the number of hours, and so your total cost is going to go up. So the cost of your labor is a variable cost in that situation, as it is in most situations. But think of a GM factory, or a Ford factory, or a Chrysler factory, any of the big automakers. Okay? Suppose the plant is shut down that month because there's no demand, or because there's a debt crisis and the company can't afford to keep its stores open. Suppose the plant is shut down that month, so zero production. Okay? But also imagine that the workers have a union contract. Okay? And that union contract entitles them to be paid a certain minimum amount per month, even if your workers are simply sitting on the bench and not producing anything. Okay? And these kinds of contracts are fairly common when you have collective bargaining. Okay? So in that scenario, is that cost now purely variable or not? Is it purely variable? Because you have production going all the way down to zero, but has your total labor cost gone all the way down to zero? No. It's still a certain amount, a minimum amount that you have to pay. Okay? So when you have some kind of union contract like that, that has the ability to transform what's normally a variable cost into something that's partially fixed, that has a fixed component. Okay? So don't think that any cost is inherently always variable or inherently always fixed. Just like with direct and indirect, you always have to examine the situation, examine the circumstances very clearly to find out whether it's indeed variable or indeed fixed. Okay? Don't anchor, don't make these mental associations, certain costs always variable, other costs always fixed. And then, so the point that you raised about costs that are partially fixed and partially variable. So, we talked about direct and indirect last week, right? And one thing you may have noticed is that direct and indirect are mutually exclusive classifications. If one cost is a direct, if some cost is direct with respect to a cost object, that means that it can't be indirect with respect to the same cost object. So they're mutually exclusive. Fixed and variable, on the other hand, are not mutually exclusive. You can have the same cost being somewhat fixed and somewhat variable at the same time. Okay? And costs like that have elements of both fixed costs as well as variable costs, so which have a fixed component and a variable component, we call them mixed costs or semi-fixed, semi-variable costs. Now there are two types of examples you could think of these mixed costs. Let me give you the first example. So remember the cell phone contract from last class. Let's imagine you put the number of minutes, your activity on the x-axis, and your total cost on the y-axis. And let's imagine your contract works the following way. Anywhere from 0 to 1,000 minutes, to pay $40, okay? And then from 1,000 minutes onwards, if you exceed that quota, if you exceed that limit, then you pay for every additional minute at the rate of, say, $1 a minute. Okay? So after this $1,000 point, what happens to the graph? It starts going up like this with a slope of 1. Okay? So now you see really what's happening. Within the range of 0 to 1,000, what is the behavior of this cost? Within the range of 1,000 to, say, 1,500, what is the range? Between 1,000 and 1,500, what is it? Is there any doubts about that? Between the range of 1,000 to 1,500, is it a fixed cost? Clearly not, right? Is it a variable cost? Imagine that only this section of the graph exists. blank out all the other sections of the graph in your mind. It's a fixed cost or a variable cost? It's a variable cost. So now over the entire range, between 0 and 1500, what kind of cost is it? It's somewhat fixed and somewhat variable. Okay? So this is one example of a mixed cost. So you have a cost that's a pure type for one portion of the range, and which switches to another type in another portion of the range. Okay, so over the entire range, it's neither completely fixed nor completely variable. Okay, so that's one example you could have. Or you could have a cost that looks the other way. You could have, in fact, this is a better example, something that varies up to a point and then afterwards just stays fixed. This is also an example of something that's partially fixed and partially variable. Okay, so that's the first type of example. Now, the second type of example you could have is imagine your cell phone contract looks the following way. You pay a basic fee of $10 a month, plus you pay a usage fee of $1 a minute. Okay? So this is what your contract is. You pay a basic fee of $10 a month. That's just your subscription fee or whatever it is. And then you pay a usage fee that varies depending on the number of minutes you use. So if you were to graph this, how does it look? How does it look? Is it like the first one? So ask yourself the following question. Suppose you use 0 minutes. What is your total cost? So the first point is going to be 0, 10. You all agree? Suppose you use 11 minutes. What's your total cost? Huh? $11. Suppose you use 12 minutes. $12, and so on. So to settle a straight line that slopes up, and what is the slope of this line? 1. It slopes up with 1. So every minute that you move to the right here, it increases in height by 1. So it slopes upwards by 1. But how is it different from the variable cost graph that we saw last class? Okay. Okay. How is it different from? Yeah, it doesn't start from 0. So even if you use 0 minutes, the cost doesn't go all the way down to 0, but there's a small fixed component. Do you see that? The portion that stays fixed, and it stays fixed at 10. That is why the graph cuts the y-axis at 10. Okay? So this is another example of a cost that's somewhat fixed and somewhat variable. It has a fixed component. There's a $10 component that stays fixed, and then has another variable component. If you were to write out the equation for this cost, we were to dub this cost y, okay, and you want to think of the number of minutes as x. How can you express y in terms of x? That's it. 10 plus 1 times x. Okay? So it's just a line with an intercept of 10. As opposed to the variable costs that we saw last class, which were just simply lines with 0 intercept. They intercepted the graph at the 0, 0 point. Okay, so two examples of partially fixed and partially variable. Any questions about this? Okay, so let's introduce some more terminology that you need in order to move on. So the first piece of terminology is a very simple one, okay, and it's very important. You'll use this for the rest of the course. What is meant by a cost driver? Okay. Now, cost driver is simply used to refer to whatever activity is driving our costs up or down. Okay. So, in this case, in the cell phone case, what is the activity that drives your cost? Usage, which is measured in time or minutes, right? So minutes or usage, however you want to express it, that's the activity that's driving your cost, right? So that is your cost driver. Okay. If you were to think of a cost of gasoline for your car, okay, what is the cost driver there? Just miles or distance traveled, right? So that's the activity that's driving your cost, that's causally pushing your cost up or down. The more you do that activity, that is what results in more or less of that cost. So that is simply what you mean by the cost driver in any situation. So you'll notice that your textbook also tends to use the term cost driver more than it does the term activity. Okay, and simply you should refer to whatever activity or whatever action is driving your cost up or down, as the case may be. So now that we have that terminology in place, something very, very important for the rest of this class. So let's imagine, go back to the cell phone graph. Okay, everyone's comfortable with this, right? It's a simple example, simple numbers. So let's imagine, let's put some more detail onto it. Let's imagine that the contract is a constant 40 up to 1,000 minutes. Okay, for every minute in excess of 1,000, you get charged an extra $1 a minute. Okay, let's suppose that extends only up to 1,500 minutes. And then suppose you go above 1,500 minutes, then you get charged for every extra minute, let's say, an extra $2 per minute. Okay, so the cost keeps escalating the more you exceed your usage quota. So it escalates upwards and it has an increasing slope. You all understand that this is a more steeply sloped line than this one, right? So this slopes upwards to, and let's imagine that that's how it is until 10,000 minutes or whatever it is. Okay, the maximum allowed. Okay, so you all understand that within the range of 0 to 1,000, this is a pure fixed cost, right? Very simple, no disclaimers there. Between 1,000 to 1,500, what is it? It's variable, but it's variable at a specific rate. It's variable at the rate of $1 a minute, right? Now, how about between 1,500 to whatever the upper limit is? Again, it's variable. It continues to be variable, but is it an identical variable cost to what we have here? No, it's variable, but it has a different variable behavior, right? It's variable at the rate of, let's say, $2 per minute. That's what we decided, right? So here's something very important that this graph illustrates. Just do not believe that a particular cost that we describe as fixed is universally fixed over its entire range. Do not also believe that any cost that we describe as variable is universally variable over its entire range. Any statements you make about a cost being fixed or about a cost being variable only apply within a certain range of activity. Okay? Always. Because costs over a larger and larger range can change their behavior. Something that behaves as a fixed cost up to a certain range, like here, can change its behavior and start acting like a different kind of cost, like a variable cost after a certain point in its range. Okay? So any statements you make about costs being fixed or about costs being variable, keep in mind they may not apply universally to that cost over its entire possible range. So whenever you talk about a certain cost as being fixed, it is always a good idea also to specify what? What is the range that you're talking about within which the cost is fixed? Similarly, whenever you talk about a cost as being variable, it's again also a good idea to specify what is the range of activity that you have in mind. Okay, because it is very difficult to find examples of costs that retain the same behavior, that continue to remain fixed over their entire range, or which continue to remain variable in exactly the same way across their entire range. Okay, the point is clear? So always specify the range within which the cost is behaving the way in which you're describing it. But at any point in time, you are not equally interested in all the ranges possible. Like imagine you're the one person who has this contract, right? Let's suppose your normal monthly usage is between 500 and 700 minutes. Okay? That's your normal monthly usage, and you figure this out by looking at, say, your last 5 years of telephone bills. Okay, that's your normal monthly usage. So clearly, that is the range that you are most interested in, right? Now, the cost could have a different behavior across other ranges, but that is just not that interesting. It's not that relevant to you because those ranges are outside of your normal level of activity, right? So for any cost that you're thinking about, there will be a range within which you normally operate or within which you expect to be operating, right? And that's going to fall within one particular block out of these possible blocks. And that block is simply what we refer to as the relevant range for that cost. So in this case, if you discover that your normal range of usage is 500 to 700 minutes, well, what is the behavior of this cost within that range? It's fixed at 40. In fact, it's fixed at 40 all the way between 0 and 1,000. So this range within which you are operating and within which the cost retains a specific behavior is your relevant range, or is the range that's relevant to you. Okay, so the term relevant range is not even it's not even a term. It simply refers to the range of activity that's relevant to you because you expect to be operating within it, or you are already operating within it. Okay. Now suppose your normal usage is between, let's say, 1,200 and 1,300 minutes. Okay. What is your relevant range in that case? 1,000 to 15,000, right? So the relevant range in any case simply refers to what is the range within which you are operating and within which the cost retains a specific kind of behavior. Okay? So let's look at an example from your textbook to bring out this concept a little bit more for you to understand why it's important. So if you look at your handout, this is the example of Thomson Transport Company. Okay. Okay, so here are the facts. So Thomson rents refrigerated trucks that carry agricultural produce to market. Each truck has annual fixed rental cost of 40,000. Okay, if you rent one truck, you pay 40,000 an annual fixed rental for it, regardless of how much you use it. The maximum annual usage per truck is 120,000 miles. Okay, so that's the maximum that you can use each truck. I don't know, imagine that it just blows up after that point. Okay, we will look at I'll give you some slightly more realistic examples. This is a little bit of a made-up example just to illustrate that point. Okay, now suppose Thomson only expects to drive 50,000 to 100,000 miles in 2006. Okay, now how many trucks do they need in that case? One truck, right? And so what is their annual rental cost going to be? And is it fixed or variable within this range? It's fixed at 40,000, right? So let's graph that. So we put the number of miles, always put the activity on the x-axis and put the total cost on the y-axis. So this year, you expect to drive 50 to 100,000. So what is the relevant range within which we are currently operating? Now think about this. Anywhere between 0 and what? 120,000 miles. Our rental cost is going to remain fixed at 40,000. And this year, we are going to be bang spot in the middle of this range. So our relevant range for 2006 is 0 to 120,000, right? Now what happens after? Why do we stop it at 120,000? Because what happens to the cost, to the total cost of truck rental if you need to drive beyond 120,000 miles? What do you need to do at that point, operationally? You need to get another truck, right? And so in that case, your total cost is going to do what? What is your total cost going to do at that point? It's going to double to 80,000, right? So we look at next year. So next year, suppose we expect to drive a total of 200 to 240,000 miles. Okay, so clearly more. So we need 2 trucks in this case. And so our total rental is going to be 80,000, right? So in fact, anywhere between 120,000 and 240,000, your total rental is going to be 80. Okay? So if you are driving 200 to 240,000, next year you have moved out of this range into the second range here. This is your relevant range now, 120 to 240. Okay? And then the last scenario is, suppose Thompson expects to drive in 2008 between 100,000 and 600,000 miles. Okay, so let's put that down here. 480,000. 600. Okay. So if you expect to drive between 100,000 and 600,000 miles, then what is the nature of that cost? You could need, think about this, as few as one truck and as many as 5 trucks, right? So over the entire range of 100 to 600,000, is your truck rental cost a fixed cost now? Because if you're at the bottom end of that range, if you're at 100,000, your cost is going to be $40,000. At the top end of that range, if you're at 600,000 miles, your cost is going to be something more, right? The cost of 5 trucks, $200,000. So over the entire range, your cost has now become somewhat of a variable cost. Okay, in fact, this is exactly what the cost looks like. Between the range 240 to 360, you need 3 trucks, so the cost is going to jump up to 120,000, and then 360 to 480 is going to jump up to 160,000. 480 to, pardon me if the lines are not exactly aligned, but I hope you all get the idea. So this is 40K, 80K, 120K, 160K, 200K. Okay, so within each of those smaller ranges, the cost is a pure fixed cost, right? Within this range, it's purely fixed at 40. Within this range, it's purely fixed at 80, and so on and so forth. But what happens when you look at it over the entire range, between 0 and 600,000? It starts becoming variable, or at least the least that you can say of it is that it stops being a purely fixed cost, right? Because you can see that as the activity level increases, the total cost is certainly increasing. Now, is it increasing linearly? Yes or no? Is the cost increasing linearly with the number of miles driven? So what does it mean for a cost to increase linearly with the number of miles driven? It means that for every extra mile that you drive, your total cost has got to increase by exactly the same amount. And that's clearly not the case here, right? Also, if you had a cost that increased linearly with the number of miles, your graph would be a straight line with some slope. And here the graph is clearly not a straight line, right? But I want you to remember something that we said last class, which is that a cost does not have to change linearly with activity in order to be a variable cost. All that it has to do is that the total cost has got to increase as your total activity increases, and you clearly see that happening here. Right? In fact, if you want to describe this graph mathematically, it's what we call a jump function, because it stays fixed up to a point and then it takes a discrete jump to a new point. Okay, so this is a jump function. But the basic message that I want you to take away from here is that particularly when you talk about fixed costs, okay, always remember that the cost might not be fixed at that same point over the entire life of its range. But as your activity increases and it moves out of a range, suddenly the cost might become variable, or it might jump to a new level and can change. Its behavior will change. Okay? So all fixed costs will remain fixed only within a certain relevant range, up to a certain relevant range. Now this example is not that peculiar. Think of something that you guys are very comfortable with, which is rent. Okay? So imagine the BMW factory from last week. Imagine that the factory has a capacity to make 50,000 cars a year. What does it mean? Has the capacity to make 50,000. That's the max it can make. Okay? So anywhere between a 0 cars and 50,000 cars, your cost is a fixed cost, right? Regardless of whether you make 0, 10, 20, 30, 40 or 50,000, it's going to stay fixed at whatever amount, 1 million, 2 million, whatever it is. Suppose you need to make the 50,000 and first car. Okay? What is your total cost going to do at that point? What do you need to do at that point? When you need to make the 50,000 and first car. Sorry? You need to get more space, right? Now, can you incrementally get just extra space to make enough to make one car? Maybe in some alternate universe, right? But chances are not likely. You cannot expand your capacity exactly by the number of units that you want. So, because capacity is only something that you can acquire in blocks, right? You have to go out and buy chunks of it. So, let's suppose, in simple assumption, suppose you go out and acquire another facility of exactly the same size as the current one. Between the 50,000 car and the 50,000 and first car, what is your total rent cost going to do? It's going to double. And then eventually at some point you will exhaust the capacity of that factory, right? And then when you exceed that range, your fixed cost is again going to take a jump. So in fact, all fixed costs behave like this. Okay, so when you think about costs as being fixed, remember, it's only within some range. Okay, it's only within the range that's relevant to you, whatever range that you're concerned with that you're talking about. Okay, this is absolutely clear to everyone? Okay, so let's extend that. I want you to hold that thought for a moment, okay? So as your range expands, what we saw here, your fixed costs tend to become variable. They tend to start varying, right? But think about this now in a slightly different way. Imagine the same factory, the same BMW factory with an annual rent of $1 million. Okay? Just imagine you signed a 1-year lease on that factory that obligates you contractually to pay $1 million in rent. Let's suppose now you are planning your production for the next 3 months. Okay? You're planning your production over the next 3 months. Now the lease cost is very much a fixed cost as far as you're concerned, because you're contractually obligated, you've signed the contract, you need to pay rent at whatever it is has been decided, regardless of how much you decide you want to produce over the next 3 months, right? Now let's change it up. Let's imagine you are planning your production over the next 5 years. Okay? So imagine you're planning your production over the next 5 years. Okay? Now, is your lease cost now purely fixed, or has the nature of that cost changed when you look at it over a 5-year horizon? And some of you, if you think it has, why? What is different now about that lease cost when you look at it over a 5-year horizon? When you plan over 3 months, remember, you signed a 1-year lease, well then you're contractually obligated to pay the amount. There's no getting out of it. It's a completely rigid fixed amount. Right? But suppose you're planning for the next 5 years, what happens when you come to the end of the first year? You could change the terms of the lease. The other guy could change the terms of the lease. You could decide to wind down your production altogether, bringing the cost to zero. Or you could decide to go out and double your factory space and get another lease at exactly the same amount. So at the end of the first year, there is an opportunity now for you to be able to vary that cost, either because of a decision that you make or because of other factors, right? So that cost is now not purely variable, because now you have the opportunity to renegotiate it, and the amount could change over a longer time period. So you recognize, as you look at a cost over a longer and longer time period, it starts becoming more and more variable, because in the long term, you can always change everything around if you look sufficiently long enough. Okay? So another extension of the same idea is that over the very long term, most of your fixed costs will start becoming variable in some way, because you can change. Nothing is completely fixed in the infinitely long term. At some point, you will always be able to change your contracts, change your agreement, change whatever it is that's binding you to that rigid number in the short term. The converse of that is, as you look over shorter and shorter periods of time, the more and more of your costs are fixed. Okay? So two things that I want you to remember. As the range of activity expands, more of your fixed costs will start becoming variable. And similarly, as the range of your time, as the time period that you're looking at also expands, more and more of your fixed costs will start becoming variable. Questions? Okay, so one last fact about fixed and variable costs is I want you to circle back to last week where we talked about direct and indirect costs. Okay, so let's relate the two. Let's relate direct and indirect to fixed and variable. Okay, so just like with before, again we tend to inherently make assumptions about the relation between direct, indirect, and fixed variable. Now, when you think of direct costs, like you're thinking of again things like material, labor, and so on, right? And costs like material, labor, etc., tend to be in general what, variable or fixed? Can you repeat the question? When you think of direct costs, you're thinking of stuff like material, you think of the BMW, the cost of the tires, the cost of the steering wheel, and so on, right? And those costs tend to be variable or fixed in general. And to be in general variable. So we have an association between variable and direct costs. And also the other way, when you think of indirect costs, you're thinking of stuff like rent, and rent in general tends to be fixed, right? So we again also have this sort of unconscious association between indirect costs and fixed costs. Those associations on average are true, but again they're not true by theory. There's no rule that makes it so. Okay, so all direct costs do not have to be variable, and all indirect costs do not have to. There's no natural one-to-one mapping between those two types of costs. So you could have costs of all four kinds. You could have costs that are direct and variable, direct and fixed, indirect and variable, indirect and fixed. Okay, so there's a very useful picture on your notes that helps to illustrate that. So, direct, indirect, fixed, variable, fixed. Okay, so imagine the BMW factory again, with the X5 and some other stuff. Okay. So if you want to think about it, the cost of the tire that you use to assemble the car or any other component that goes directly into the car is a direct cost, and it's also a variable cost. So tires, other raw materials. How about the wages, the salary paid to the supervisor who supervises the X5 line? The direct or indirect? The supervisor who supervises the X5 line. Direct, right? Is it fixed or variable? Fixed. I told you salary. So, salary of X5 supervisor. Okay, how about electricity to run the X5 assembly line? Imagine that there's a separate metering, so you can track. So it will be a direct cost. That's another example of direct and variable. Let's think about rent on the facility. Okay? Indirect, right? And fixed. How about a cost that's indirect and variable? If you thought about your electricity bill, or for that matter any other kind of supplies, and you had a single bill for the entire plant, and that would be an example of the indirect cost, right? But it's also going to be variable, because the more you assemble, the more you run your machines, and any other costs like electricity, other supplies, and so on. So you can have costs, you are not meant to memorize these examples. The point being made here is that you can have costs that belong to all four types. Okay? So do not believe that direct costs are variable and vice versa, and that indirect costs are always fixed and vice versa. Okay?
There's some examples that it could be either one.
Yes. Yes.
If we put lines and we give you the reason why we said that.
Yes, yes. Typically, you will not be asked to classify something into variable or fixed. You'll be told that something is variable or fixed, and you'll be asked to do some mathematics that illustrates that you understand how variable and fixed works. But even if in the occasion that you were asked to classify, yes, I'll either try to give you a specific situation. I will tell you, imagine that there's a single meter for the entire plant or something. Or if that's not there, then you make your assumption and then you state your answer after the assumption. So answer your question. Okay, so okay, let's move on. One last way of looking at costs, okay, which is total and unit. Now, total and unit cost is not really a cost classification. Okay, I hope you understand that. It's just two mathematical ways in which you could deal with costs. You could deal with costs either in total dollars, or you could deal with costs on an average basis, on a per unit basis. And we saw that when we talked about fixed and variable, right? And you understand that these costs have very different behaviors based on whether you look at them in total or whether you look at them on an average or per unit basis. So anytime I talk about total cost, I'm going to be talking about how much does it cost in total dollars to make so many units of something. Okay? Anytime I talk about unit costs, okay, unit costs, and you should understand that I'm talking about the average cost per unit of making one of something. Okay? So let's do a comprehensive example. Shows the difference between total and unit cost. And this is again an example from your textbook. So Tennessee Products, they make speaker systems. Okay. Everyone's able to find this stuff on the handout? Okay. So imagine that in the first year, total manufacturing costs were 40 million, and they were incurred to produce 500,000 speakers. Okay, so what is the unit cost? Yeah, what's the average cost per unit? What's the unit cost? Okay, 40 million divided by 500,000, which is what? Okay, bring your calculators out if you don't have them already. 80, thank you. 80 per speaker. So this is simply what we refer to as what we mean by unit cost. Okay, the average cost per unit of making something when you have many units being made. The average cost per unit. Okay, this is clear. Now, what are these unit costs helpful for? They're helpful for many things. They're primarily helpful for financial accounting. Okay, they're primarily helpful for financial accounting because the unit cost describes the average of what it cost you in the past to make so many units of something, right? And that way of thinking about numbers is typically the financial accountant's way of thinking about numbers, right? Because the financial accountant uses this information to describe what happened in the past. So let us suppose that this year you sold 480,000 of these speakers. Okay, what is the amount that you record for cost of goods sold on your income statement? What is the amount that you record for cost of goods sold on your income statement? What is the amount that you record for cost of goods sold on the income statement? Sorry? Is that 480,000 times 80? So your cost of goods sold roughly is going to be 480,000 speakers. That's the number of speakers you sold times the cost per unit, which is 132. Okay? Now, I'm sorry? Okay, can someone multiply these two numbers and please let us know? So this is your cost of goods sold. Okay. So now, is that the entire manufacturing cost? No. The total manufacturing cost is 40 million, right? What happens to the remaining 1.6 million? Is that your profit? Where does it show up on the financial statement? This is not managerial accounting. It's just a financial accounting pop quiz. shows up in ending inventory. Okay? And where does ending inventory go on your financial statements? It shows up on the balance sheet. Okay? So your ending inventory is going to have 1.6 million. Okay? So the specifics of this are not important. The point being made is that average costs per unit, or unit costs as we refer to them, are very useful and are primarily used by the financial accountant, okay, while describing what happened last year. Now, average costs per unit are very dangerous when you use them to do managerial accounting tasks. Okay? And here's a hint of why. Because managerial accounting relates to decisions about the future. Right? We're not trying to describe the past, we're trying to make decisions about the future. So anytime you're trying to make a decision about the future, you must be very, very cautious about using an average unit cost from the past. Okay, you must be very cautious. And let's do an example that shows you why you must be cautious about using this number. Okay, so suppose we know now some additional information that the total costs of 40 million, that out of the total costs of 40 million, 10 million are fixed. Okay, 10 million are fixed costs, and the remaining 30 million are variable costs associated with the manufacture of the 500,000 speakers last year. Okay, so now you're being given some additional information. You were told that out of the 40 million, a 10 million component is fixed. FC always means fixed cost. And then another 30 million is variable. Okay, so some additional information that we didn't have before. Okay, now, here's the question. Here's your task. What is your best estimate of what total costs will be next year if the factory manufactures A, B, C, three scenarios: 200,000 speakers, 500,000 speakers, and 800,000 speakers. Okay? So here's a couple of assumptions that I would like you to make. Assume that the production method and style and all of that has remained exactly the same from last year. And also assume that the factory that you already have has the capacity to make 800,000 speakers. Okay? Two assumptions. Assume that your production method is completely unchanged from last year, and also assume that your capacity extends up to 800,000 speakers. What you have right now can make up to an 800,000 speakers without having to acquire some additional space, blah, blah, blah. Okay? So, three scenarios. The number of speakers: 200,000, 500,000, 800,000. And what you're asked to do is to estimate the total cost. Okay, so think about it for 2 minutes and then tell me how we go about this. What will be the total cost of each of these three manufacturing scenarios? Think about it for a minute or two. Here's a question: does the unit cost stay at 80? So think about that question, all of you. So if it did stay at 80, then it would be a very simple exercise, right? We wouldn't need too much time. We would just take the 80 and then multiply it into 200, 500, 800. So let's do that. Actually, for a thought experiment, we'll put those numbers down, then we'll think about whether they might be right or not. So 200,000 times 80 is 16 million. 500,000 times 80 is 40 million. 800 times 80 is 64 million. Now, who thinks that these numbers are going to be accurate? Oh. Now, who thinks the numbers are not accurate? These are not accurate estimates of what total costs will be next year for producing 200, 500, and 800. You have an opinion, thank you. The rest of you don't have an opinion? You always have to have an opinion in this class, okay? It doesn't have to be the right opinion, but you have to have an opinion. It's crucial to surviving in this world. You have to be opinionated. Okay, so if you don't think these numbers are correct, how do you go about estimating total cost? Someone give me a method of predicting what total costs will be next year under each of those three production scenarios. Someone start. You've had your hand up for a while. Okay, very good. So there's a variable cost component, there's a fixed cost component, right? And the total cost is always going to be the sum of those two. Now, can you predict each of those components together? Can you predict your total variable cost and your total fixed cost together in one step? It's not a good idea. You should always predict your fixed cost separately and predict your variable cost separately, because you understand the two costs behave very differently. So you have to predict them separately. You have to estimate them in two separate steps. So someone please first estimate for us what total fixed costs are going to be under these three scenarios. Good. So your total fixed cost is going to be 10 million, 10 million, and 10 million. Everyone's satisfied with this. Yeah? Because it's a fixed cost. It stays at that amount because our total capacity is 800,000. Okay? We don't need to acquire any additional capacity under each of these three scenarios. Now, how about your total variable cost? How do we go about estimating that? Mm-hmm. Yeah. Mm-hmm. Yeah, very good. Okay. So a number of steps there. But before we even go to that example, let's take some simple numbers. Okay, and I like to give this example, and students always like to laugh, but it's a useful example to keep in mind. The only logic you need to apply here to estimate total variable cost is what I call the apple math. Okay, from second grade, which is if 5 apples cost $10, how much do 8 apples cost? $16, right? And what you just described to us is exactly the same as that, right? So what do you know? You know that 500,000 speakers cost 30 million in variable costs. So that must mean that each speaker cost you variable cost of how much? What is the variable cost per speaker? 30 million divided by 500,000. Right? So your variable cost per speaker is 16. Therefore, if you manufacture 200,000 speakers, what is your variable cost going to be then? It's going to be 200,000 times 60, which is what I've written, and then 500,000 times 60, and 800,000 times 60. Okay, it's the exact analog of 5 apples cost 10, how much do 8 apples cost? Okay, it's the exact same series of steps that you're doing in your mind. Okay, but why do you have to do it this way? Because that's how variable costs are incurred. Remember that variable costs vary in total but are fixed, what? Per unit. Remember that? That's the fact that you want to use. You want to find out what that variable cost is per unit. You need that number because only then can you take that number and then multiply it into the number of units that you're going to be making this period in order to estimate your total variable cost. Okay? So, from last year's information, 500,000 speakers cost 30 million in variable cost. Therefore, each speaker cost 30 divided by 500,000. Therefore, your variable cost per speaker was 60. Okay? So now that you have your variable cost per speaker, you can easily use that to estimate your total variable cost. So keep in mind your variable cost per speaker is 60, and it stays at 60 per speaker in each of these three scenarios. So your total variable cost is going to be 60 times 200,000, which is 12 million. 60 times 500,000, which is 30 million. And then 60 times 800,000, 48 million. So you can estimate total cost now. It's just the sum of your total fixed cost and the total variable cost. So 10 million plus 12 million, 22 million in the first case. 10 million plus 30 million, 40 million in the second case. 10 plus 48, 68 million in the third case. Okay. So now let's actually compare these numbers, what we have here, assuming that these are more correct, to our initial numbers that we started out with. Our guesses here were correct in 1 out of the 3 situations. Do you notice? That these guesses here turn out to be correct in 1 out of the 3 situations. Which one? The 500,000. Why do you think that's the case? Why do you think that's the case? Because it so happens that our production volume in this year is exactly the same as what our production volume was last year. So the numbers it's only by coincidence. If this had been say 400,000 or 450, our estimates here would again have been different. Okay? So now let's complete this by calculating one more number to calculate unit cost in each of these scenarios. Okay, how do you go about calculating unit cost in each of these scenarios? Have someone else. What is the meaning of unit cost? The average cost per unit. Okay, Randy? The total cost, which is 22 million here, for example, divided by the number of speakers that you make. Okay, so go ahead and calculate the unit cost in each of the scenarios and tell me what it is. 22 million divided by 200,000, which is 110 per speaker. Next one is 40 divided by 500. Because we have the same parameters as last time, the unit cost also turns out to be the same. Thank you. 58 million divided by 800,000 is, thank you, 72.5 per speaker. So many things that you can observe from these numbers, right? Let me circle them to make it easier for you to see. Well, first of all, as expected, what happens to our unit cost as production goes up? It keeps decreasing, right? We make only 200,000 speakers. We're only using up a very small portion of our total capacity, right? As a result of which that entire rent and insurance on the whole factory is being spread out over only a few units. And so our average cost per unit is high. On the other hand, when we start using the factory at close to its full capacity, our average cost per unit starts going down. Okay? And you notice again that the unit cost, Eric, this answers your question, the unit cost only in this particular scenario coincides with the unit cost from last year. Why? Because it just so happens that this scenario has the exact same production volume as last year. So does everyone understand now why you simply cannot take a unit cost from one year and use that to predict total costs for next year? Right? Because when your costs are always made up of some fixed and some variable component, you understand the fixed component and the variable component are going to behave differently. Okay? And so you always need to predict each of those two components independent of each other. In fact, you just use this basic formula and that will guide your thinking. You never go wrong. And the total cost is always your total fixed cost, the 10 million in this example, plus your variable cost per unit times the number of units. At any time you have fixed and variable costs, this is how you go about predicting. You first estimate your total fixed costs, right, and then you estimate what your variable costs are per unit, and then you multiply that into the total number of units. Okay? Another way to think about why you can't use this number is the following. That's your cost per unit. Your cost per unit is made up of two components. It's made up of a variable cost per unit plus a fixed cost per unit. Right? Now, your variable cost per unit is always the same. Your variable cost per unit in this case is what? 60. In the second scenario is also 60. And in the third scenario is also 60. Right? But what is your fixed cost per unit in each of these scenarios. Your fixed cost per unit in the first scenario is what? 10 million divided by 200,000. So your fixed cost per unit is 50 in the first case. The fixed cost per unit in the second case is 10 million divided by 500,000, which is what? 20. And in the last case is 10 million divided by 800,000. What is 10 million divided by 800,000? What is it? Go ahead and calculate. What is 10 million divided by 800,000? Sorry? 12.5. Okay, 10 million divided by 800,000 is 12.5. Okay? And where do you think these numbers fit in here? Your total cost per unit is your variable cost per unit of 60 plus your fixed cost per unit of 50. That's where the 110 comes from. In the second scenario, it's your variable cost per unit, which continues to remain 60, plus your fixed cost per unit, which is now 20. That's where the 80 comes from. And in the last case, again, your 60 plus your 12.5. So your unit cost next year is going to depend very much on how many units you produce next year. Okay? If next year you produce fewer units than you produced last year, your unit cost is going to be what? Higher or lower than it was last year? Higher. And vice versa. If next year you produce more units than you produced last year, your unit cost is going to be lower than what it was last year. And that's exactly why you cannot just take your unit cost from a previous period and then use that to estimate what your cost will be for next year. Your unit cost is something that you can calculate after you estimate your total cost. But you can't use it to estimate your total cost. Question? On average.
And that also be applied for variable costs such as the pay, the production of employees.
How so?
So that, let's say you have an employee that makes 10 units maximum, but since you sell less than the maximum units that you can sell, means less worth to do, then the unit, the cost is going to go up in the variable, in that variable cost that you pay that employee. So if it's only producing 3 units, then the cost per unit is going to be what you pay him divided by those 3.
I don't completely follow. Yeah, I don't completely follow. In that case, it might not be a variable. Okay?
It's just based on the production